At this point, I trust that you have developed a strong understanding of the concepts and benefits of dividend growth investing, as well as why we believe it is one of the most effective strategies in generating wealth over long periods of time. Considering the fact that we have covered an abundance of information throughout the course of this book, this chapter will serve as an overview of the most important concepts for your convenience. The threats to our financial wealth and dividend growth investing when two titans collide. From the age of 4, when we are first thrust into the education system, to our late 50s, the difficult working years approaching retirement, we spend most of our lives devoted to building up our financial wealth. This realization poses a very serious question. If we spend the majority of our life trying to build our financial wealth, why do we not spend an equivalent amount of time trying to protect it? I believe the most significant takeaway from this passage is the fact that despite the clarity of its message, most of society continues to remain guilty of not taking sufficient measures to protect their hard-earned wealth. Unfortunately, most Canadians forget the most important stage of the wealth management process because they are simply unaware of the threats to their financial wealth. If we were taught how significant an impact these threats can have in the long run, society would place a much greater emphasis on pursuing investment strategies that can combat these risks. As a response to society's false perception of the true meaning of wealth management, I dedicated the first half of this book to explaining in great detail the most detrimental threats to our financial wealth. 1. Understated inflation. 2. Low interest rates. 3. Longevity risk. 4. Taxes. 5. The media. And 6. The investor. These threats make it clear that the motivation for achieving long-term returns on our capital should not arise solely from the desire to simply maximize our wealth. Instead, the purpose of striving to achieve above-average returns is to create a defense mechanism that will protect us from the ultimate risk, running out of money in retirement. In addition to society's lack of awareness with regards to the threats to our financial wealth, we have also been misled in our belief that the main path towards significant wealth creation is through employment income. This mentality cannot be farther from the truth. To truly protect ourselves against threats to our financial wealth and generate significant sums of money over the long run, we must consider employment income to be a supplement to fuel our contributions to investment accounts. The sooner this concept becomes evident, the sooner the investor can truly maximize the power of dividend growth investing. As reiterated countless times throughout this book, we believe dividend growth investing is the most effective strategy to protect ourselves from the many threats to our financial wealth as a result of the following 4 solutions. Number 1, enhanced investment returns. Number 2, yield on cost. Number 3, principal preservation or downside protection. And number 4, a quantitative approach. I would also like to make an honorary mention to 3 additional solutions discussed throughout this book. These solutions are 1, the power of compounding interest. 2, the dividend tax credit. And 3, asset location. What we find very interesting is that each threat to our financial wealth can be eliminated through at least one of the solutions provided within this book. Understated inflation and a low interest rate environment can be solved by achieving enhanced investment returns. Longevity risk can be solved through focusing on yield on cost and the power of compounding interest. The effect of taxes can be alleviated through the dividend tax credit and utilizing an effective asset location strategy. The negative influence from the media can be solved by employing a quantitative approach. And the negative influence of our own emotions, we refer to this threat as the investor, can be eliminated through employing a quantitative approach and the downside protective qualities provided by dividend growth investing. Throughout this book, we have referred to each solution independently in order to provide a deep understanding of how the dividend growth approach operates on multiple fronts. With that being said, it should be quite evident that each solution, in fact, leads to the ultimate goal of generating enhanced investment returns, which is the first main solution. Yield on cost focuses on the growing investment income component of dividend growth investing, which ultimately leads investors to reap enhanced investment returns. Principal preservation focuses on limiting the investor's losses during market corrections, which also leads to enhanced investment returns. Dividend growth investing takes advantage of the power of compounding interest, which naturally contributes to this investment philosophy's ability to generate enhanced investment returns. In addition, employing a quantitative approach ensures investors remain disciplined throughout the entire investment process and make investment decisions off company fundamentals rather than based off emotions and investor sentiment. Investors who employ this approach are likely to also reap enhanced investment returns. Even taking advantage of an effective asset location strategy or the dividend tax credit leads to enhanced investment returns, since investors can lower their overall tax liability and consequently achieve a higher net return. When all is said and done, the ultimate goal for investors is to generate enough wealth that will enable them to live comfortably in retirement. To achieve this goal, investors must employ a strategy that has the capacity to generate enhanced investment returns. The dividend growth approach clearly possesses this capacity, as illustrated throughout each individual solution's ability to combat against each of the threats to our financial wealth. Understated inflation and low interest rates versus enhanced investment returns. In the second chapter of this book, we introduce the first two threats to our financial wealth: understated inflation and low interest rates. The combined effect of understated inflation and low interest rates is detrimental to investors because our interest-bearing securities, such as GICs, will not be able to keep up with the real rate of inflation. Therefore, our wealth will deteriorate over time. Historically and on average, companies that have grown their dividends have outperformed all other publicly traded companies. In Chapter 6, titled Enhanced Investment Returns, we displayed a graph that compared the growth of $1 million from 1986 to 2016 for different companies within the world of equities. This graph illustrated that a $1 million investment in dividend growth companies from 1986 to 2016 would have provided the investor with roughly $13 million more than a $1 million investment in companies that paid a static dividend. These above average historical returns provide reassurance that a portfolio comprised of fundamentally sound dividend growth companies is likely to generate a return that is greater than the real rate of inflation. In other words, dividend growth investing can help prevent our wealth from deteriorating over time and can in fact grow your wealth over time. To further support this point, we also compared the returns provided by dividend growth investing to that provided by interest-paying securities, mutual funds, and even real estate investing. In all three cases, the average dividend growth stock provided a historical return higher than that of the average interest-paying security, mutual fund, and real estate property. Longevity risk versus yield on cost and the power of compounding interest. In Chapter 3, we introduced the concept of longevity risk, the risk of running out of money during our retirement years. Throughout the chapter, we used a number of different examples and evidence to arrive at the following conclusions. 1. A longer retirement period has a significant impact on our financial planning requirements. 2. Society's flawed view of risk motivates investors to believe low risk equals low volatility, which in turn makes their ability to generate a return sufficient enough to reach the point where they have enough money to last the entirety of their retirement years even more difficult. It should come as no surprise that a longer retirement period means investors must not only save enough money prior to retirement, they must create an index pension to ensure that their retirement income grows at a faster rate than the rate of inflation. In Chapter 7, we introduced the concept of yield on cost. The yield on cost ratio enables investors to evaluate how much their investment income has appreciated since the time of their initial investment. As a reminder, the yield on cost equation is calculated as follows. Yield on cost equals annualized dividend or interest payment in most recent year divided by the investor's original principal or the investor's original investment. If you recall, we used an example of yield on cost to illustrate how dividend growth investing can be used to create an index pension. Consider the following two portfolios. Portfolio A, multiple GICs which provide the investor with a fixed interest rate, guaranteed principal repayment, and a predetermined investment period. Portfolio B, multiple dividend growth companies that provide the investor with a growing income stream, the potential for share price appreciation, and an unrestricted investment period. Despite the fact that Portfolio B is more favorable than Portfolio A on multiple fronts, it is the rising income stream that should be regarded as the greatest advantage. With GICs, since the interest payments received by investors remain static over the entire investment period, the investor's purchasing power diminishes over time after accounting for the effects of inflation. However, with dividend growth investing, the investor can help eliminate the risk of outliving their retirement savings contingent on the following two factors. One, the company's ability to grow their dividends at a faster rate than the rate of inflation. And two, a dividend income high enough to fund the investor's expenses in retirement. If both factors are satisfied, the investor's risk of outliving their retirement savings is completely eliminated, regardless of the length of the retirement period. The investor would never need to tap into their retirement savings since their income from dividends alone would be large enough to fund their lifestyle expenses and would not diminish as a result of inflation since dividends would be growing at a faster rate. In other words, in this example, the investor would have successfully created an index pension through dividend growth investing. In addition to yield on cost, we introduced an investment tool that transforms longevity risk from a threat to our financial wealth to a supplement, the power of compounding interest. In order for an investor to take advantage of this solution, we explained that the investor must first disregard society's flawed view that low risk equals low volatility, since investments that have the ability to maximize long-run returns generated through compound interest are generally more volatile. While obtaining a high yield on cost ensures an investor's income in retirement grows at a rate faster than inflation and consequently ensures the investor's income is sufficient enough to fund their retirement expenses, the power of compounding interest helps investors save enough wealth prior to beginning their retirement. To explain the solution, we first provided definitions for both simple interest and compound interest. Simple interest is the percentage return generated by a security is based off the investor's original principal, and compound interest is when the percentage return generated by a security is based off the investor's original principal plus all previously generated returns. The main difference between compound interest and simple interest is the fact that returns generated by compound interest enabled securities compound off all of the wealth accumulated through previous returns in addition to the original principal. At this point, we compared the dollar returns of a simple interest yielding security to a compound interest yielding security. Security A is a simple interest yielding security, and the investment is $100,000 invested in a 5.6% yielding GIC. And security B is a compound interest security, and the investment was a $100,000 investment in the Canadian stock market yielding an annual average return of 5.6%. So each year the return would be 5.6% on average. If you recall, the results were beyond outstanding. After 50 years, the 5.6% annual compounded return provided by the Canadian stock market generated an outstanding $1.1 million more than the 5.6% annual simple return provided by the GIC. In percentage terms, the stock market generated a 1,425% return, whereas the GIC generated a relatively pathetic 280% return. This simple yet powerful example validated the notion that the longer the time period a compound interest security has to compound, the larger the annual dollar returns will become. Investors who choose to disregard society's false notion that volatile securities should be considered high risk will truly be able to take advantage of compound interest. In doing so, the true risk to their financial wealth, not saving enough money to last for the entirety of their retirement years, will be minimized. While longevity risk poses a significant threat to our financial wealth, it is quite evident that yield on cost and the power of compound interest are effective solutions that mitigate the negative effects. Taxes versus the dividend tax credit and asset location. In Chapter 4, we introduced the negative effect of taxes on our investment returns. Unfortunately, it is impossible to completely eliminate taxes since the government will always expect to receive a portion of our hard-earned wealth. While we cannot eliminate this threat entirely, in Chapter 4, we illustrated multiple strategies as to how we can minimize this liability. After evaluating the effects of taxes on interest, dividends, and capital gains, it became clear that capital gains receive the largest break. Not only do investors maintain control over the timing of their tax liability, the magnitude of the tax liability is also significantly lower. With that being said, while dividend and interest-seeking investors both do not have any control over the timing of their tax liability, the magnitude of the tax charged on dividend income is lower than that charged on interest income as a result of the dividend tax credit provided to shareholders in dividend-paying companies. This preferential tax treatment is an initiative by the government to motivate investment in Canadian companies. In addition, since companies pay dividends from after-tax profits, in other words, the dividends have already been taxed at the corporate level, the dividend tax credit aims to eliminate double taxation. In addition to the dividend tax credit, investors have the ability to minimize their tax liability by utilizing an effective asset location strategy. This strategy involves the allocation of asset classes to specific account types that will ultimately minimize the portfolio's overall tax liability. In Chapter 4, we explained how investors can reduce their overall tax liability through making proper use of the following three account types. Number 1, a non-registered account. Number 2, a registered retirement savings plan. And number 3, a tax-free savings plan. For non-registered accounts, investors should prioritize holding non-income producing securities before dividend and interest paying securities, and then they should prioritize dividend paying securities over interest paying securities. For RSPs and TFSAs, investors should prioritize holding interest-paying securities before dividend-paying and non-income producing securities, and prioritize dividend-paying securities over non-income producing securities. By doing so, the investor would be able to minimize their overall tax liability. For an explanation as to why this priority scale results in the most efficient outcome for the investor, I encourage you to revisit Chapter 4. The media and the investor versus a quantitative approach. In Chapter 5, we explained how the concept of purchasing fundamentally sound companies at a discount does not resonate well with the investment community. When prices are increasing, investors are more than willing to invest in an attempt to join in on the rally. When prices are decreasing, investors often panic and sell their positions out of fear that prices will continue to decrease. This reverse philosophy of buying when prices are high and selling when prices are low is not only flawed, it also has the potential to be incredibly destructive to our financial wealth. Unfortunately, this flawed concept has slowly transitioned to become a norm in the investment community as a result of the following. Number 1, an injustice committed by the investment media to cover topics that will maximize profit rather than properly inform investors. And number 2, lack of responsibility from investors to keep themselves informed and follow a basic rule of thumb. All else equal, high prices are bad and low prices are good. In Chapter 9, we discussed how employing a quantitative approach to investing ensures that our investment decisions are unaffected by emotions and the opinions of others. Quantitative analysis is the process by which companies are ranked from ideal to not ideal investments based on their ability to meet a number of preset investment parameters. The top 20 to 24 companies that best satisfy the investment parameters are then added to the portfolio. When combined with the dividend growth philosophy, the parameters are constructed in a way that ensures only companies with sound fundamentals and a proven track record of dividend growth will enter the portfolio. A quantitative approach completely eliminates the risk that our investment decisions are influenced by emotions and the opinions of others because the portfolio is constructed based on whether a company's fundamentals are in line with the investment parameters. If they do not fit, they are eliminated. It is as simple and straightforward as that. This process helps ensure that emotions are completely removed from the investment decision and instead 100% of the decision is based on company fundamentals. The investor versus principal preservation. In the previous subsection, we mentioned how one of the many flawed concepts accepted by the investment industry is the notion of buying when prices are rising and selling when prices are decreasing. One reason as to why this concept has been accepted for so many years is a result of a lack of responsibility from investors to keep themselves informed and follow a basic rule of thumb. All else equal, high prices are bad and low prices are good. When stocks decrease in price as a result of factors unrelated to the underlying company's fundamentals, investors should view this as an opportunity to increase their position in good, strong companies at a discounted price. The temporary decrease in the value of our portfolio is simply the price we pay for premium returns in the long run. With that being said, in the event of a significant market correction, one resulting in losses in excess of 20%, it is very unreasonable to expect investors to remain perfectly calm and collected. In fact, in this scenario, many investors would end up selling their securities out of fear that their investments will continue to drop in value. In the previous subsection, we explained how a quantitative approach completely eliminates the threat of the investor making investment decisions based off emotions because the portfolio is constructed based on whether a company's fundamentals are in line with the investment parameters. In the event of a severe market correction, dividend growth investing can reduce the probability that an investor ends up making an investment decision from an emotional standpoint because of its principal preservation qualities. As mentioned in Chapter 8, the most influencing factor that has motivated me to become a discipline of dividend growth investing is the recession-resistant qualities that it incorporates. There are two main reasons why dividend growth companies generally preserve more capital during market corrections than all other equity classes. Number one, the fluctuating dividend yield, and number two, the positive signal released from a growing dividend track record. As we now know, the dividend yield is one of the most important metrics dividend investors consider when making investment decisions. In short, the dividend yield tells investors the return they will receive in the form of a dividend as a percentage of the company's share price. Before the investor makes the investment, the share price is their anticipated principal value since it will be the price they pay if they choose to make the investment. As a reminder, the equation for a dividend yield is dividend yield equals annual dividend divided by the share price. The fluctuating dividend yield is what prevents dividend-paying companies from losing a significant amount of value during market corrections. This defense mechanism can be explained in three simple steps. Step 1. Once a market correction is underway, investors lose confidence and sell their dividend-paying company in an attempt to get out before their stock loses more value. This nature of panic selling amongst uneducated investors applies downward force on the company's share price in the short run. Step 2. The sharp decrease in the share price without any change to the company's dividend causes a sharp increase in the company's dividend yield. Step 3. The higher dividend yield is immediately recognized by investors who seek a higher than average income yield. As a result, investors eager to take advantage of the higher than average yield purchase the shares of the dividend paying companies, placing upward pressure on the stock price once again. While the dividend yield is the primary defense mechanism that dividend paying companies have to their advantage during market corrections, dividend growth companies have an indirect defense mechanism which provides even more downside protection. As mentioned throughout this book, companies that have a proven track record of continuously growing their dividends are regarded as fundamentally sound companies. By no means do these firms have any obligation to pay dividends. It is simply their choice. Continuously increasing their dividend, let alone simply paying a dividend, provides investors with the positive signal that the company has the ability to generate earnings in excess of what is required to fund future growth projects and repay debt obligations. Therefore, a track record of continuous dividend growth is not simply a cash payment paid back to shareholders. Instead, it provides investors with the comfort of knowing that the company in which they are invested in is fundamentally sound and better able to weather the storm in the event of a market correction. During market corrections, funds tend to flow into assets like gold because they are considered to be safe havens. Fortunately for dividend growth companies, this trend also occurs between different companies in the stock market. Since dividends provide shareholders with not only a cash payment, but also reassurance that the company's operations are not under any immediate risks, potential investors are motivated to transfer their wealth to dividend growth companies from companies with more ambiguous operating risks. By limiting the amount of principal loss during a significant bear market, investors are less likely to act on emotions and sell their positions while prices are decreasing. Concluding thoughts. I truly hope this book has provided you with a deeper understanding of the many benefits dividend growth investing has to offer and why we consider it to be the most powerful wealth creation strategy available to investors. I would like to end off with this final message. The above average returns generated from dividend growth investing can only be achieved by maintaining a long-term focus, disregarding short-term market fluctuations, and investing in fundamentally sound companies with a proven track record of consistent dividend growth. By employing a dividend growth approach and understanding the concept that employment income should be used to fuel contributions to investment accounts, your journey towards achieving financial freedom just became significantly shorter.